Hi everybody,
Hello to everyone, man.
you are tuned into Nong and my name is Nell.
And my name is Lebu, right? Today's topic is really engaging, and I really love this topic, right? Because now we're getting a lot of questions coming around this. Why would I actually buy my house below market value?
True. I mean, there's so many strategies out there, and this is one of the strategies that we want to put on the table. We're not saying do it. We're just saying that this is one of the strategies that can actually work out for you.
So now we're going to give you both the good and the bad and let you decide, right? For the good, I'll actually name three.
Okay.
I'll look at the three that actually resonates into my heart, right? First one that I wanted to talk about is that it protects the investor from market crash, right? So now what do I mean that it protects an investor from a market crash, right? Say for instance, right, you actually bought your house way below market value, right? As we're talking about, you always need to buy your property below market value on around a 70% discount, right? So now say for instance, Neo just recently bought his house at a 70% discount, right? And then boom, the market crashes, right? Once the market crashes, it goes towards 90%. The market actually shaves off 10% of his value in the property, right? So now what happens for Neo is that he actually has that 20% that he still negotiated down, right? So now, say for instance, you actually bought it at market value, right? And then the crash hits, right? So now what happens is that you're sitting at a 10% loss before you even do anything. Right, before you even do anything. So I think that's the one reason that I think that you should actually consider before actually buying a property.
True. I mean, with our engagements with property investors this week, it's been quite interesting that there's so many strategies.
Yeah.
We heard others buy on appreciation. Others do buy on appreciation, and that's their strategy, man. So now I would ask myself, okay, if I'm buying on appreciation, and then let us say that the market didn't appreciate. Now, if that means the market didn't appreciate, and now let's say in this case it was a flip. So what's going to happen is that I bought it at market value. I'm going to put nicer tiles. I'm going to put in a good shower. I'm going to put in everything that's excellent, only to find out that the market is not actually reacting. That's going to come back to me as the property investor because I'm reliant on the market. They are our customers.
I think it's like the example that we're always making, right? That you have a property, right? You'll fix it up and make it to become this property that would sell in a perfect market, right? But now when you're looking at the market that you're actually in, right, it's a lower class as compared to what you had fixed it, right? So now you have to actually check those things. What are the comps around doing? When you're talking about comps, you're not only talking about the numbers, or how are the properties that are within the area.
Also your target market, man. Who's that person that will be buying?
Yeah. So number two of the good side, right? We're looking at an increased margin, profit margin, right? So now say for instance, you buy this particular property, both for rental and for your flip purposes, right? And you actually buy it below market value, right? This decreases, number one, your transfer duties, right? Number two, this actually decreases your monthly payments towards your bond, right? So now this actually helps that profit margin to actually drop, even if, for instance, the first time when we talked about it, that the market crash might happen, right? When the market actually crashes, you're not actually affected in terms of the value of your house if you actually bought it below market value. But now if you bought it on the market value or maybe slightly above the market value, then it's a problem for you.
Let's say we've got investor one and then we've got investor two, and then we had the same identical properties. Now we're twins now. We're property twins now. We have the same property that has the same rooms, and it's you bought it at 1 million and I bought it at 700,000. That means I'll be paying less.
Yeah.
And we're both receiving the same amount of rentals if they're both in that same area.
Exactly.
So what does that mean? That means my return on investment will be higher than yours.
Yeah.
Yeah, man.
I hate that I was the wrong one on this particular example, right? So now, when you're looking at the third one, right? When you're looking at number three, we're talking about flexibility, right? When you're talking about flexibility, we're talking about how low can you actually drop the price for that particular house, right? Say, for instance, you buy a property. No? Once you actually bought this property, you bought it below market value, right? If you bought it 70% below market value and you were planning to sell it at 800,000, right? And then it happens that no one is actually buying this property. You can actually decrease it to around 750, depending on what would that return on investment be for you to be actually happy right? So now, if you actually bought it at market value and you are trying to actually increase the prices, and you see that this property is not actually moving, you'd be forced to actually decrease it to market value. And if you bought it at market value, you're already running at a loss if you're actually going to resell it again with the market value.
I mean, you look at it, if we were looking at rentals and then we bought it as distressed and below market value, already that in itself is an exit strategy.
Yeah.
So going back to what you just said right now, flexibility, we're able to maneuver. If this doesn't work, renting doesn't work, we know that we bought it below market value. We can sell it as a business, or we can sell it above that price that we got it for and get a profit. So, I mean, as property investors, you would be, even though it didn't work out with that property, you would be able to move on to another one with the profit. Hence, we're always talking about not being emotionally attached to your property.
Now we'll give you the bad side,
Very.
because he's always thinking about the worst case scenario.
Okay.
Now, just kick us up. What's the first one?
BAV versus BMV. So
What does
are we
that
talking
mean?
BAV, below asking value,
Okay.
versus below market value. For instance, let's role play now. Let's role play quick. You are the estate. Let's say I'm the estate agent and you are the property investor.
Sure.
So I have a house listed under me at 1 million, but I know that it's worth about 900,000.
Sure.
So what's going to happen is that you're going to come to me as an investor and I'll be like, hey, investor, I know you.
How are you, sir?
I know you.
You know me.
Don't you want it cheap?
I do want it cheap.
And then I'll be like, you know what? I can do a good thing because you're my friend. How about if we can move it to 900,000? Then what are you going to say?
No, there's something fishy here. There's something fishy, right? I'll first do my due diligence before I actually go in with the offer to him, right? Because now I think Nell will actually explain what that means, right?
True. So now below asking value is that amount which is on the market price can be reduced to the real market value. So it's important for you as the property investor to do your due diligence in terms of knowing what is the real market value, not by looking at the site and looking at that amount. BMV is below market value. We're looking for houses that are below market value. How do you know that? You get a reputable report that talks about that house's value, and then that's when you can actually compare the two.
I mean, just to go in right there, right? A lot of people have emotions towards, they have this emotional attachment towards their property, right? So now you're always trying to get the best money that you can actually get out of from that property. That's why I think Neo actually talked about the BAV, below asking price, right? Below asking value. So now this is when someone says that his house is worth 1.5 million, where in actual fact their house is worth 1 million. So now just be sure about that, right? Before you actually purchase a house, make sure that you actually do a thorough check before you actually make a offer. Because now you may see that, okay, I offered it at 1.3 million, and then they were saying 1.5, but now when you actually go deeper into this particular property, you see that this property is only valued at 1 million.
Implication number 2 is that latent versus patent defects.
Oh my God, what's latent and what's patent? You're coming with these new terminology, man.
Latent is those defects that are structural, defects that are quite heavy to the pocket, that you as the investor do not want to find yourself in, unless if that is your expertise.
Yeah.
Now with patent, that's when we're talking about your, if one can say, defects that are not so bad. For instance, if the house needs to be painted there and there, or if
a few windows are cracked, maybe. Because now when you're looking at distressed properties, right, you might not know what is going on in that particular property. You find that from the outside, it looks perfect, right? But now when you go deeper inside, when you go towards the plumbing of the property, it's terrible. It's terrible. So now I think that will fall part of the latent. So now how do you actually see if something is latent and patent? If something is like really, really bad and it really costs a lot of money, then I think it would fall under the latent. And then the patent would be just those cosmetics that we always like to talk about, right? The windows, maybe the paint, maybe probably something that's not really expensive.
How you protect yourself from the situation, because sometimes you can go view a house and then you'll be like, it doesn't look bad, it's cosmetics, but you do not want to find yourself in that situation. So how do you protect yourself? Is that you get a power team.
Yeah.
We do not know everything in property. However, if we have a property, if we have a power team, and we know that these people are on the ground and experts in whatever field that they are in.
I think what's really important is that before you actually put in an offer, right, make sure that you take your construction guys so
That's
that
it.
they can actually come and check everything thoroughly, so to make sure that there are no structural damages, there are no latent, as Nell has just told us, there are no latent damages happening in that particular property, right? Because now the last thing that you want to do is that you tell your person that, no man, you know what, come to this house once you have actually bought this house, right? You'd rather have them come check it first and then they give you the go ahead to actually buy that.
With number 3, we have bad location. You know, sometimes that somebody's property will be on the market for about 6 months, 8 months, 1 year, only to find out that the problem was not with the property itself. The property looks amazing on the pictures. The property, let's say it's a multi-let, however, it's in a bad location. The laws of economics, supply versus demand.
Yeah.
So if you have this beautiful, amazing property, multi-let, fully furnished, it's ready for people, however, now the market is not receiving it well, that will be a problem. So now you do not want to find yourself whereby somebody had that problem and now they're like, what can I do with this thing? How can I dispose it as soon as possible?
Let's put it below market value.
Let me put it below market value and see who's going to come in. And then you did not have that knowledge before you actually went in the deal.
Yeah.
And you're like, this looks like such a good deal. I'm ready for it. Let me go for it.
It automatically turns you into a distressed home seller.
True.
You do not want that situation as a property investor. Thank you for tuning in.
Man, it's been awesome. We appreciate your support. Keep supporting us, guys. Let's move together. And we did say that our main aim is to build a network whereby we can share information and grow with each other.
And remember, if you watched until the end, please type in a pro, man. Let's confuse them.
That's our code. That is our code.
Let's confuse them, man. Put in a pro. Please do subscribe. Nong
signing out.